Hello, everybody. Welcome to our energy webinar. My name is Heitor Paiva. I am the oil analyst here at Hedge Global Markets. And today we will be talking about the main fundamentals that we expect that are going to be relevant for the oil market in 2022. And for that, we're going to have Jonathan Kornafel talking about strategies. He's our head of energy based in New York in the end of the presentation. And I'm going to stick to the fundamental side. So today I will talk about some charts that we are monitoring when it comes to COVID, and then we are showing just some charts on the global crude and product supply and demand fundamentals. And we end the presentation talking about the United States and how we are seeing stocks and refinery demand there. And then Jonathan Kornafel wraps it up with some strategies and how market participants can mitigate risks in 2022. So when we talk about oil demand, I think it's pretty much relevant to just to give an overview of what we are seeing when it comes to COVID. So yes, we are seeing COVID cases now starting to peak, and yeah, actually they have already peaked in Europe and in the United States, but in the emerging markets they're only starting now to peak. But again, I think even though Omicron was a pretty much spreading variant, I think its mortality rate is something that we should take into consideration, because even though, yes, cases went up, significantly up, deaths did not the way they did in the past waves. So this indicates that Omicron is indeed perhaps a milder variant, and should other variants follow this trend, it's pretty much expected that oil demand will be impacted less in the future. And not only because it is expected that these variants become progressively milder, but also because we are seeing several countries in Europe now, which is the region where restrictions were taken most seriously in the world, starting to talk about understanding COVID as an endemic. So we're seeing Denmark, for example, and England lifting their restrictions now because perhaps they think it's time people start to live with the virus. And this is a very positive fundamental for oil, for mobility, and consequently oil demand. And just a quick update on mobility here. I think it's important to mention that, yes, cases have gone up, but the same way with the same velocity that they went up, they're now falling in Europe and in the United States. And something I think it's extremely important to mention is the fact that even though cases went skyrocketed, mobility did not fall as much as in the previous waves. So there is some kind of resilience in oil demand right now in mobility, and perhaps this is what's going to mark the next waves going forward. People living with the virus regardless of what cases are, because we have vaccines, we have new drugs coming to the markets, which are making COVID look more controlled, at least in the medium term. And just an update here in Omicron, the same way it went up, it's peaking. It already peaked and it's now falling. So we're seeing New York, London, and South Africa, which are the locations where Omicron first hit, already overcoming their peaks, and kind of a sense of normality is expected to appear as soon as this variant is fully overcome. The big question is, will other variants show up? It is pretty much likely that yes, but again, we're not seeing fundamentals that support the view that demand will be impacted by them. Okay, so people are learning to live with the virus, and this kind of mentality is expected to maintain oil demand at pretty much robust levels going forward. And because of the fact that people are now starting to live with the virus and governments are talking about understanding COVID as an endemic, we're seeing oil demand recovering pretty much fast. Okay, and the reason for why prices are so elevated, both for crude but also for product, is because supply has not been following this move, as we can see here in the left chart. So demand went up, but supply is still lagging. Okay, and this explains why we're seeing heavy backwardation in oil contracts right now. For example, Brent is showing a significant backwardation, indicating that the market participants' view towards the future is that supply tightness is likely to persist, at least in the short term, and this is extremely positive for oil prices in general. And apart from that, I think it's important to comment that supply is not really seen picking up, okay, at least in 2022, the way it would require for prices to go down. because we are seeing OPEC getting progressively incapable of increasing their production from where they are now. Okay, so what we're seeing here on in the left chart is basically the difference between the total oil production capacity and the actual production. Okay, and the difference between capacity and actual production is a proxy for spare capacity. So what we're seeing here is that only Iran and Saudi Arabia have significant spare capacity volumes. But the question is, are they likely to pump more in the short term? So Iran remains sanctioned. We're going to talk a little about this in a minute. And Saudi Arabia is not very much used to producing oil above 10.5 million barrels per day, which is currently what the country is already producing. So I wouldn't be surprised if OPEC did not increase production the way it is planning to, and therefore continue to sustain oil prices. Okay. And when we look outside OPEC, but also to the big oil companies, I think their financial strategy is also bullish fundamental for prices now, because instead of investing their capex in exploration and production of crude oil right now, like it would normally do, given where oil prices are right now, it's not been doing that. Okay, so what we're seeing is that big oil company and also independent producers are prioritizing delivering financial returns now instead of reinvesting in production. Okay, so because of that, we're seeing oil supply remaining constrained in the moment when theoretically they need to pick up. Okay. And again, I think it's important to comment that many analysts have been saying that the Fed is a major bearish fundamental for oil prices and right now, okay? But this is not exactly our view right now, because what we're seeing now is an inflation basically caused by the supply side, namely tight supply chains and depleted commodity inventory. And because of that, policy rates tend not to affect that much these two variables. Okay, so inflation is expected to be around for more time than what we are anticipating, and therefore oil is not expected to be impacted by this hawkish turn in the Fed, because oil is an inflation hedge. So speculators are likely to bet on oil, to get long on oil contracts in order to hedge their exposure on inflation. Okay. And just to add to our bullish perspective is China, because we know that China went through a significant economic deceleration in 2021, but it's been recovering. So we are seeing its economy giving signs that it's moving towards the right direction. So we're seeing like Chinese monetary and fiscal authorities proactively acting on these two fronts in order to reconquer growth. So we're seeing, for example, medium-term and short-term lending rates in China falling, and also we're seeing the credit impulse going up. So these are two indicators that suggest that China is trying to regain growth by injecting more credit in the economy. And we are starting to see results of this strategy. So when we look in to the right chart, we see that steel output, which is a leading indicator for the Chinese economy, is starting to pick up. And when it does pick up, it normally drags other sectors, like, for example, the refinery one. Okay. And of course, there are downside risks to our bullish perspective, and Iran is one of them. Okay. We know that Iran remains sanctioned. And it's negotiating with the West in order to be allowed to legally export its oil. Okay, even though we're seeing some media outlets saying that negotiations are getting to an end, it does not mean that Iran will be legally allowed to export oil again, because we know that Iran has continued to enrich uranium. We know that Iran has a lot of nuclear infrastructure, and no one really knows what to do with these two major issues. So we are not expecting any outcome, at least in this next 6 months, because it takes time for them to negotiate such a serious matter. Okay, but this means that Iran is not expected to be a bearish fundamental, at least in this semester. But of course, Iran has significant spare capacity and could increase its exports by 1.5 million barrels per day in less than 1 year. Okay, and of course, its production has been recovering, and is expected to continue because Iran is getting ready to export oil. But again, I think it takes time for them to be legally allowed to export its oil. And geopolitics are also relevant when it comes to the gas market, for example. Okay, so basically, what we've seen in Europe, we all know what's going on between Russia and NATO regarding Ukraine, and I think the tensions with Russia did not start in 2022. They started in 2021 when basically Russia started to withhold its gas supply to European customers, and we saw that by seasonally low Russian gas flows towards the northwest Europe. And also we can witness the outcome of the situation in the European gas stocks. Okay, so the thing is, this conflict is between Russia and Ukraine and NATO is getting calmer now, but I wouldn't be surprised if these tensions last throughout 2022 and therefore continue to negatively impact, for example, the amount of gas that Russia supplies Europe. Okay, so again, I think that the gas tightness in Europe is expected to linger in 2022, and therefore add a bullish, at least a bullish perspective for Henry Hub prices, given that the United States has been exporting a lot of LNG and therefore tightening its S&D. But the big question is the United States really able to increase production? Will it save the day when it comes to both crude oil and also natural gas markets? So I think that this is a relatively hard question, but where drilling activity remains now, we're not really seeing crude oil production, natural gas production really increasing that much from where it is, because we know that they've been withholding a lot of capex. And this means that their capacity of increasing investments is limited by this, okay? But we're going to see some charts on that. But I think it's important to mention that what's going on in Europe right now is basically this geopolitical conflict. And the United States has a major role in supplying natural gas to Europe and is trying to increase its market share there, okay? So, but the question is, is it able to increase even higher its exports, its LNG exports? It is trying to. The United States is trying to send more gas to Europe right now. But again, there are infrastructural limits. So its export capacity of LNG is around 11.6 billion cubic feet per day, which means that volumes much above this export capacity are not really capable of being exported. So there's limited help that the United States can offer to Europe right now, and therefore TTF futures, for example, are expected to remain elevated at least in the winter, given that Russia has continued to withhold supply amid all these tensions. And when it comes to the capacity of the United States in adding production, specifically in the crude oil segment right now, I think it's important to mention that, yeah, as we're seeing relevant oil basins in the United States starting to produce more oil. But the thing that we would like to highlight here is the fact that drilling activity has remained pretty much subdued in the Permian, but also generally speaking for the United States. And also the number of wells that were drilled but are now waiting to be turned on, or drilled but uncompleted wells, is at a 5-year low. So there's not really of a spare capacity for American drillers to produce more oil, which means that in the short term, any production increase in oil and gas in the United States is expected to be short-lived, unless this outlook on DUCs or drilled but uncompleted wells starts to revert. But again, considering that they're not really increasing capex spending that much, the gas and oil production of the United States is expected to remain fairly muted. And of course, this is because the financial strategy of shale producers in the United States is pretty much similar to what's going on in the big oil right now. So there is this general preference for withholding capital expenditure in order to deliver better financial results for their shareholders. So ultimately, the consequence of this financial strategy is you create free cash flows and you deplete capital expenditure, which would normally go towards exploration and production of crude oil. And when we look at the demand side, I think it's fairly important to comment that yes, refineries in the United States are enjoying strong crack spreads right now because because fuel inventories in the United States remain pretty much seasonally low, which has been supporting a lot gasoline prices, namely. Okay, so we're seeing a strong environment for American refineries, which are expected to continue witnessing strong crack spreads. I think it's important to comment that American refineries now have a structural advantage when compared to their American peers, European and Asian peers, because mainly of natural gas prices. We know that Henry Hub futures are extremely elevated on a year-to-year basis, but when we compare to gross values, for example, we're seeing like Henry Hub prices way below their peers like the European TTF or the natural gas Asian market, the LNG Asian market. So the desulfurizing costs of American refineries tends to be smaller right now, and they have access to cheaper natural gas. So their fixed cost tends to be smaller, and therefore their refinery margins are seen really better than in Europe or in Asia right now. And when we talk about how depleted fuel inventories in the United States are, I think it's we all know that. But when we put this into perspective, it's pretty much shocking to see the days of disposition, which is basically crude oil and which is basically stocks adjusted for domestic demand and exports. So we see that both of them, crude oil and refined products, are tight below their 5-year average. But when we look to what's going on with the refined product side, it's pretty much warning because it is seasonally low, indicating that yes, prices are pretty much responsive to this tightness. Okay, so the situation is not really much expected to revert because demand is robust in 2022 and is expected to continue. So given that Omicron is now being overcome, we have driving season in the corner. So there's a lot of positive fundamentals for demand that we are seeing right now. And just to conclude now, I think it's important to comment that we are seeing very bullish fundamentals for the energy complex as a whole. Okay, not only because there is the supply and demand balance tightness that has been driving crude oil and other product prices higher, but also because speculators are likely to use energy commodities as an inflation hedge, given that the Fed will not be able to end up inflation because inflation is being driven by the supply side, and adjusting higher, Fed funds rates are not likely to end this problem. So eventually, money will hide out in energy and support prices going through 2022. So I'd like to thank you for your attention, and now I'm calling Jonathan Kornafel for him to share his strategies with us and how market participants can navigate 2022 in order to mitigate the risks. Thank you.
Thanks, Heitor. So now we're going to take a look at some strategies, some producer, some consumer strategies as well, and see how the interaction of these different strategies sort of affect each other and affect the market. So let's get into it. Let's see here. All right, so let's talk about producers for a few minutes. We've seen a lot of producer interest on this rally, on this long, drawn-out rally. And this is how energy prices, how crude oil prices generally tend to move. You have a lot of sideways movement, a lot of upper movement, movement to the upside. Over a long period of time, and the pullbacks are generally where the violence is. There's a lot of volatility when the market starts to drop, and they're usually quick, surprising, and violent. But then the market will generally trend to the upside. So we've seen producers coming in, buying puts, selling swaps, and buying producer collars, which is buying a put and financing that purchase of the put by selling an upside call. And we've seen that on this entire rally, back from when crude was below $50 all the way up to where we sit now in between 85 and 95. Now, what that's done is this long period of a rally and producers buying puts is it's really caused quite the put skew, which means that producers buying puts generally will inflate the value of those puts because it's just a big sort of one-way market. You also have money managers and speculators also on these high prices coming in and buying puts so that they could profit from the downside moves. But it's really an interesting phenomenon that as the market's gone higher, you see more and more hedging, and that put spread, the put skew, those puts that are already expensive continue to get even more and more expensive. Now, I think an interesting phenomenon that as we get close to $100, and if we do end up breaking over $100 at some point this year, what you'll see oftentimes is producers coming back in and buying back some of the short swaps that they sold out at $50, $60, $70, or even $80, because opinion starts to turn, maybe a little bit of panic. There's big margin calls to be made on those short swaps as the market continues to rally. So what you get is sort of a self-fulfilling sort of cycle there, where the market starts to break a lot higher, and we would probably see something to this sort above $100, $105, $110 Brent or WTI, where the shorts, the producers come back in and buy back a lot of their short hedges. Now, what that does is that then propels the market higher, because at the same time you're seeing that nervousness on the producer side, you also see it on the consumer side. So there's a lot of airlines, a lot of shipping companies, a lot of consumers out there that waited to hedge or did some hedging on the way up. But when you get one side that starts to get a little nervous on the producer side, you also get the consumers getting nervous. So that sort of fills in, and you get the same thing. You get more consumer hedging, more buying when we break above these psychologically significant levels like $100, $105, $110, that drive the market higher. So in a sense, you'll get both producers and consumers coming in at those elevated levels and buy, and the producers buying back and the consumers adding more hedges. We haven't seen that to much of an extent yet, but it's certainly something that to worry about, and something that lurks a little bit over the horizon if we do continue to go higher. I think an interesting phenomenon, again, to use that word, is the put skew, and how that feeds through to often provide a hidden benefit for jet fuel hedgers. The put skew, as I said, can get quite elevated, and this graph on the right is sort of a very simplistic representation of the put skew at two different prices. So what you see on the far right is the at the money. Now, for the orange line, let's pretend the at the money is currently $85 for Brent. All right, and that orange line, as we move further to the left, is graphing the extrinsic value, the volatility premium in the put options as we go lower in price. So you see there is a put skew, but that put skew doesn't really come into play until we get a lot lower. It's pretty flat at first, and then it starts to really go up the y-axis. But should the at the money drop to $75, if we end up trading at $75, that's the blue line, and you see that put skew all of a sudden immediately just below 75, you're going to get a big, strong put skew there, and that's a result of a lot of the producer hedges buying up those puts, a lot of investment money potentially hedging the downside as well. So there's always going to be a put skew in the Brent and WTI markets, in the crude oil markets. It's just a matter of sometimes the put skew is more pronounced, and it generally is more pronounced at slightly lower prices than where we are right now. At 85, 90, 95, the put skew is generally flat for the first $5, $10 down. There's some premium in it, but it's not as pronounced as it is when we're trading a bit lower at, say, $75 or $70. Now, how do consumer hedgers take advantage of this? Again, this is something that's caused by producers. So when we drop, when the underlying price drops and those puts become more expensive, that means all the airlines out there, the shipping companies out there that are worried about the market going higher and want to buy upside protection, they want to buy call options, well, they could finance the purchase of those call options by selling puts. And when the put skew gets really pronounced and really bid up, that means they could sell put options that are further out on the curve because they're more expensive as the put skew gets more bid up. So what that means is they're able to to push that downside, that bottom, where all of a sudden they're not taking advantage of lower prices. They're able to push those puts further away when you have a big pronounced put skew, meaning that they could buy call options that are closer to the at the money. So it's very advantageous on the consumer side when that put skew really gets bid up. And that's something at HedgePoint that we're so close to the markets, working with a lot of producers, refiners, and consumer hedgers, so that when we see that put skew bid up, we really work closely with our clients to make sure that they're taking that they see that, and if they want to, that they can take advantage of this type of move. Now, let's look at one more market, marine fuel markets. Been a little bit crazy in the last couple of years because of the IMO regulations. So let's just look at the headline here. IMO regulations regarding lower sulfur fuel and demand for lighter products continue to have an impact on the shipping market. So prior to 2020, on the marine fuel markets, a lot of the hedging was just done with the high sulfur fuel derivative contracts. It was very simple. There was a lot of liquidity there. But after 2020 and the new IMO regulations, you have a sort of a splintering of these hedges. You have some shippers operating with scrubbers. They're still using the VLSFO. You have others using sort of middle of the barrel or sort of lighter products. And then you have shippers plenty using natural gas. So and that is expected to build. So it's been a splintering of the fuel that's purchased, which has caused a splintering of liquidity in the different potential hedging contracts. So on top of that, we've had a bit of a distillate and fuel oil shortage in the Atlantic Basin lately. This is actually something that's been off and on for many, many years, but we certainly saw it this winter. Refinery turnarounds in Northern Europe and in North America, that's really not going to help the picture. And ironically, at the same time, we're seeing Singapore fuel oil stocks at their highest level in 5 months. So it's really just a bit of a crazy market right now on the marine fuel side with what am I buying, where am I buying it, is there a shortage, is there a surplus, and how can I hedge? Well, one way to really counter that is to simply use Brent, which is the global crude oil benchmark, and hedge a portion, just a percentage, maybe 10%, maybe 20%, maybe 30% of the overall fuel buy. That's one way to do it. Another way to do it is to use some of the more liquid fuel oil contracts that you see in Singapore and Rotterdam or the U.S. Gulf Coast. But again, it does depend on which fuel you're buying, where you expect to buy it, and how far into the future you expect to buy that fuel. Are you going to do away with the scrubbers? Are you going to depend on scrubbers for the next couple of years? Are you going to switch to natural gas? So a lot of questions, and hopefully we have some answers here at HedgePoint, and this is what we work with our clients on a very close one-on-one basis. All right, let's talk about, sort of wrap up some of the points that Heitor was making earlier in terms of the oil market outlook for this year and on even further into the future. One of the points was supply side elasticity to prices will remain low. I think this was very true as we broached into the crude oil prices broached the 70s, the 80s. As we started getting to the high 80s and into the 90s, especially into the mid to high 90s, I think you really started to see some production come back online. OPEC Plus, really, they're far behind in the volumes that they've promised to produce, and there's not a lot of spare capacity out there. I think that's something that could actually be very bullish if the remaining spare capacity from OPEC Plus actually did hit the market, because that's more oil hitting the market, but in the longer term, that's simply less spare capacity that's out there to make up any sort of differences. So really what we've seen is a step up very recently in shale. The drilled but uncompleted wells are at their lowest since January 2014. That's 8 years. So oil rigs are rising. So the shale market is stepping up, but it's a huge. This is more on the marginal side. It's a huge gap to fill in terms of the demand out there and where is the supply going to come from in the medium to long term. Geopolitical issues will be a key. I would say they're a key fundamental to watch. We're seeing this right now with the volatility around Ukraine on a day-to-day, almost hour-to-hour, even minute-to-minute basis, with following the news. One moment, Brent and WTI are $2 higher. The next moment, they're $2 lower. I think this is a bit of a sort of a $5 to $10 window that we see in crude oil prices. This isn't going to send us back to $50. It's not going to send us to 150 unless there's some major news, some negative news in terms of supply. But at the moment, these little news blips that we're getting, they are causing a bit of volatility in the market. And again, one way to really take advantage and sort of avoid that volatility is the costless collar strategy, where if you're a consumer, you buy a call and you finance that by selling a put, and a producer would be the opposite, buying a put and financing it by selling a call. That enables you to have that wiggle room in the middle. You take advantage when the market moves in your favor a bit, and you also, the other side of that coin is that you also have to ride it when it goes a little bit against you, but you do have protection if the market starts to move beyond your comfort zone. That's one way to sort of ride out the current volatility. The Fed's hawkishness is not expected to weaken the oil rally. I think there's a lot surrounding that. I think in the short term, I don't think the Fed is remotely hawkish right now. I think the Fed is just less dovish. Let's see what the rate increase is going to be in March, if there is one. Is it going to be a quarter point? Is it going to be a half point? How many rate increases are we going to get this year? I think that there is the expectation of some heavily indebted companies. We're talking about the Fed here, so in North America, in the U.S., and how higher rates will impact their profits, their margins going forward, their ability to operate. But I think in the short term, it's not going to impact it. But the Fed's action will definitely reverberate in the months and years ahead. I also think the specter of a lost decade looms for heavily indebted, low and middle income countries out there. So the more interest rates go higher in the U.S., I think the more you're going to, obviously interest rates are higher, you're going to see more money flow into the U.S. to take advantage of that. That's going to drive the dollar higher. That's going to put negative pressure on crude oil. It's also going to be money that's flowing out of some of these low and middle income countries that's not going to be beneficial at all for them in terms of servicing their debt that is priced in dollars. Number 4 here, speculative money will flow to oil as an inflation hedge. That's 100% true. That's always been true. We see that with the housing market right now. Absolutely. Of course, that's going to be battling as there's more inflation, interest rates are going higher. So there is a sort of give and take there. But yes, oil, gold, sort of those fixed assets type thing is that's money is always going to flow there in cases of inflation and volatility to continue in an upward trending market. Absolutely. I think volatility will continue in a downward trending market as well. I think at the moment we're looking at a bit of a pullback here. But again, moment to moment, this depends a lot on what's going on with Ukraine and also Iran. Will those Iranian barrels be hitting the market? The Iranian barrels that are on the tankers sitting offshore. Yes, I think one thing we are certainly in for is volatility going forward. I think then what we're going to do is show you guys the disclaimer quickly. And then from there, I think what I'm going to do is I'm going to pass it back to Heitor for some Q&A and some further discussion. So thanks a lot, guys. It's been great.
Hello, Jonathan. Thank you for your presentation. That was very nice to hear.
Thank you.
We got 5 questions here so far. So if you have any question, please send us in the chat. We'll be very pleased to answer them. So Jonathan, I'll be reading the questions here. So the first one here, I think it's Heitor. Do you see shale oil output rising the way IEA is expecting for the year end? Because oil output is expected to rise 110,000 barrels per day in March. So I'll take this one and you take the other one. All right, Jonathan. So I think that as we talked about during the presentation, our view on the U.S. oil production recovery is a little bit mixed. It is a fact that some private players have been rising their investments, but I think that when we look to the overall situation in the American oil fields now, I think what we got to look now is where the drilled but uncompleted well stocks is going to go, because so far drilling activity is modestly picking up, but so far we're not seeing those stocks of drilled but uncompleted wells rising. So the big question is, what will happen when the existing wells start to go through natural declines or stuff like that? They need spare capacity, and because of the fact that we're not seeing those stocks of drilled but uncompleted wells rising, there is limited spare capacity for the American oil producers to increase production. So ultimately, this makes us think that the U.S. oil production recovery could be short-lived. Okay. And apart from this fundamental, I think it's important to comment that inflation is a big issue now in the oil field. So we're seeing, I've been reading some field surveys, and a lot of oil producers are complaining about significant labor shortage, material shortage, sand shortage. Haley Burton, for example, was reporting that. That's ironic because they drill in the desert, or at least in places where there's a lot of sand. And some reports were saying that that inflation in the oil patch of the Permian reached in 2021 around 12% on a year-to-year basis. So that's a lot, and because of inflation is elevated, like cement prices, steel prices, labor shortages remain, and these prices have not fallen. The impact of these inflationary pressures on rising capex is that this rising capex will not impact production as it would normally do. Okay, so our reading is that production in the United States is not really expected to substantially make a move higher because of inflation and because we're not really seeing stocks of Dukes rising. Okay, so let me read the second question here. Jonathan, I think it's for you this here. There is so much volatility in the markets now, nowadays. As a consumer jet fuel, how can we position ourselves?
Good question. First of all, happy to be here. Good to see everybody. And I think, that's a really good question, because volatility is really going to be the theme going forward. It's been something we've seen since the start of this year and going into last year, as the market has just generally trended higher. But now we're really starting to see these more violent moves, because this is something I mentioned in the analysis from earlier, that they're really being driven in large part by geopolitics. We had the sort of the greenflation effect, which is something I think we're going to be with, for decades now in the energy industry. But adding the geopolitics issue with the Ukrainian situation is certainly another another item in the mix that has really made it much more difficult to try to read the market and try to figure out where's a good spot to get in, where's a good spot to really layer into hedges. One of the more common hedge strategies, whether it's a consumer or a producer, wherever you are on the barrel, is to use the collar strategy. Now, on the consumer side, in jet fuel with airlines, I think buying call options and financing those call options by selling put options is generally it's common, and it's common for a reason, because it is a very simple strategy to understand, and it really gives the airline, the fuel buyer, sort of a strong picture of where they are, the worst case scenario and the best case scenario, in terms of where their fuel purchases will be. Now, there's still so many questions out there regarding the global economy recovering with COVID. What do advanced ticket sales look like? What do the international routes look like? What does competition look like? What does the jet fuel crack look like? So there's a lot of confusion. There's a lot of questions, because we're just dealing with so many variables these days. And this is something that our research department, that Heitor's a big part of, really puts together these great reports and really allows us to sort of get this analysis out to our clients, and really so they can make a more informed decision, because there is no real simple answer to the question what is best in any circumstance, because it's not just the circumstance, it's also the airline and their cash position as well. Where are they buying fuel? What are they buying basis? Like I said before, are they flying international, domestic? Is what they're hedging with, is it Brent? Is there a strong correlation between Brent and the physical fuel that they're actually buying? So there's just a myriad of sort of variables in there. And when you add on the geopolitical risk right now on top of all that, it really makes it very, very difficult to sort of guess and speculate on where the market's going to go. So what we've always counseled is to always just layer into hedging strategies a little bit at a time, whether it's week in, week out, or month in, month out, sort of at the same time, the same day of the week. There's a lot of ways to sort of institutionalize those strategies so that it's almost like a 401k, that on the dips you continue to buy and on the rallies you continue to buy, and you average out at a price that's hopefully on your side that you plan for and that you're comfortable with.
Okay. So I think we got another question on Russia. I think it's inevitable not to talk about this. So the question is, what is your view on the Russian stand-up with NATO? How long is this conflict expected to continue impacting oil prices? So what I'm going to do here is I'm going to answer this question, and if you have anything to complement, Jonathan, feel free to jump in. Okay. So I think that like this conflict in Europe is not something new. It's been happening since at least 2014 right now, following the Crimean invasion. But of course, things have really worsened significantly in these last days. Okay. And because of the fact that we have a lot of oil companies investing in Russian oil fields now, such as BP, Exxon, for example, I think that this geopolitical uncertainty, which is not expected to go away so soon, will weigh on their investment plans. And for example, BP even said it: if there is Western sanctions on Russian oil, then they will comply with that. So this means that probably this geopolitical uncertainty will continue weighing on this financial strategies of these oil companies, which will ultimately lead to a more muted oil output growth in Russia. And this only adds to the already ongoing tightness related to OPEC right now that we're seeing. OPEC is now really capable of increasing production the way it wanted. So I think that as we are in the early developments of this geopolitical issue right now, I think the risk premium oil prices will continue for some time, and the lingering impact of this is that this geopolitical uncertainty will be present in the future capex decisions of these oil companies. So this adds to the supply tightness, and then our view is that the conflict is obviously bullish for oil right now, and the impacts are not expected to go away so soon. Do you have anything to comment on here, Jonathan?
Sure. You know, I would think the oil markets are certainly searching for a new equilibrium right now. I don't think they're going to find that equilibrium for some time. So I think that's going to be the resulting volatility that we're going to see, and that's something that you alluded to right there. One of the conversations we were having on the desk this morning was whether or not the rally we're seeing, or that we saw in the last 24 hours, is that a rally to sell? You know, there's always the theory of you buy the rumor and you sell the missiles. So basically what that is you buy volatility when there's questions, and then as soon as those questions are answered, that's when the volatility comes crashing down. And we saw that in the energy derivative options market this morning relative to last week. So I think it's certainly possible. What if this is as far as Putin is willing to go in the Ukraine? What if there's no more moves being made? We may be stuck in a stalemate here. There may be sanctions that are going to hurt the global economy. What's that going to do to the price of oil? However, you know, if there's not much more military activity, maybe we've seen the end of the volatility. Maybe we're going to sit. Maybe there's going to be a stalemate. Maybe we do find equilibrium at these higher prices for the time being. I do think with refinery maintenance right on looming right now, I think we're going to have a bit of a pullback. Then I think the market will return to these highs. If we do have a pullback, I think we'll return to these highs sooner rather than later. But I think this conversation here is emblematic of just the volatility that's out there, because we don't know what's going to happen next. We don't know what's going to happen next in terms of supply and demand regarding COVID, regarding just supply and demand in general. And We don't know what's going to happen anymore with the Ukrainian situation. But as of this morning, it seemed like there was a bit of a calming, which is why I think the rally in crude oil petered out a little bit. But we could wake up tomorrow morning with fresh headlines, and we could be trading above $100. So there's a lot of questions out there.
Yeah, for sure. And I think that when we talk about sanctions, it's very tough to see markets without Russian oil right now, without Russian gas, because we are seeing elevated inflation pretty much everywhere. So taking out the market more than 5 million barrels per day, or even those massive amounts of gas that Russia sends out to its European customers, it's like unimaginable. So I think that perhaps things are tough in Europe, but like this is the maximum prices can go in terms of energy, because fundamentally speaking, inflation won't allow European authorities to really sanction these supplies. And then I think we got a question here. Here, I think Jonathan, you could answer this. Do you
Sure.
see prices at the pump falling in the U.S.?
Oh
And
boy.
what is your view on future gasoline prices? I think this is a pretty much classic question, so go ahead.
This is the classic question that has no answer. I think in terms of something I mentioned a minute ago, that I think we are due for a little bit of a pullback in prices before we head into the summer driving season. Whether that pullback happens or not, gasoline prices are already so high. I think it's an interesting point. There's been a number of studies done that when the energy price rises, when the oil price rises, prices at the pump are much quicker to rise along with it. Yet when the oil price drops, those prices at the pump generally are sticky, and it takes longer for them to drop. So I think that's an interesting point, that if we are going to have a little bit of wiggle room before summer driving season for prices to drop, for consumers to enjoy maybe a bit lower gasoline prices at the pump, it's got to happen very soon. Otherwise, we're going to start bumping up against April, May, June, when that driving season, when that demand for gasoline really starts to skyrocket. So I think last I checked just a couple days ago, the national average for regular gasoline was around a little over $3.50 a gallon. I think diesel is closer to $4 a gallon. I think we're most likely, let me rephrase that. I think there's a good chance that we see the national average of regular unleaded gasoline back up at $4 per gallon, and that's a price we haven't seen since 2008. Now, that's really not good news for the drivers out there, for the consumers. But unfortunately, with the geopolitics, with the volatility, with the summer's really not that far away. We're almost done February, so I think it's I think if it's going to happen, it's got to happen soon, because I think unfortunately $4 is right around the corner.
Yeah, and I think that's something that needs to be commented here, is the fact that we are like living the moment of the year when gasoline stocks build. So we're entering a moment when seasonally gasoline stocks started falling in the United States, and add this to the fact that we are having this massive Omicron reopening, demand is there, then this tightness is really expected to last throughout the year, and therefore add to this to gasoline prices overall.
Absolutely.
So like no end in sight for those inflationary energy prices.
Unfortunately, yeah.
Yeah, unfortunately. So I think we got one question here on Iran. What are our expectations on the Iranian oil deal? So I think this is like a very tough question, because like it involves politics, and politics are always like unpredictable. But something that needs to be commented is that even if Iran is allowed to legally export its oil, we're not really seeing any impact larger than $5-6 to the oil prices. So from where we are now trading pretty much close to $100, it wouldn't be much of a difference. Like the oil markets are tight, and Iran could only partially resolve this problem, but this problem is even larger. So with that said, our view on Iran is that it has like a lot of export capacity to add, but our view is that it won't impact much oil prices. Okay, and something that needs to be commented is that OPEC may not be that much like Italy by the situation. OPEC wants expensive oil prices, And if Iran is authorized to export its oil, which I remain pretty much skeptical because of a lot of issues, I think OPEC, like it, and we got some news on that, like several OPEC sources have been telling the financial media that if Iran is authorized to export its oil, then they could simply step on the brakes and stop bringing back supply to offset the bearishness that Iran coming to the market would have. So I think we're not really getting away so soon with expensive oil prices. Iran could help, but not completely raise the problem. Like, and again, it will take time. We're seeing Iran becoming more demanding. We in terms of the United States to never withdraw from the nuclear deal again, which is something that needs to be that, in my opinion, is unimaginable. And Iran has tons of nuclear infrastructure, and no one knows what to do with that. So it won't be like this deal won't be reached from night to day. So we got to be always skeptical about this, even though the White House is trying to literally bring down prices at the pump at any cost. But like, this is a very serious issue. It won't happen from night to day. Okay. Okay. So I think we don't have any more questions. If you have any, please write us on our emails. We'll be very much pleased to answer them. Thank you, Jonathan. Again, thank you everybody for participating.